everyone. Thanks for coming. Welcome to the bank's press conference on the Financial Stability Report. On my left is Andrew Bailey, Deputy Governor for Prudential Regulation and Chief Executive of the PRA. On my far right, John Cunliffe, who's the Deputy Governor for Financial Stability. And on my immediate right is the Governor of the Bank of England, Mark Carney.
Thank you very much, Jenny. Good morning, everyone. The FPC judges that the overall outlook for financial stability was broadly unchanged for much of the period since December. However, as risks associated with Greece began to crystallize in recent days, that outlook has worsened. Events in Greece have moved very quickly. At the time of its policy meeting, the FPC judged that the associated risks were particularly acute, and just before this report was finalized, the Greek crisis intensified, and Greek authorities imposed a bank holiday and capital controls. The situation remains fluid, and it's possible that a deepening of the Greek crisis could prompt a broader reassessment of risk in financial markets. The United Kingdom is relatively well insulated from the direct consequences of events in Greece. UK banks' exposure to Greece are very small relative to the size of their capital bases, and the footprint of Greek banks in the United Kingdom is tiny compared to the size of our economy. In contrast, our economic and financial exposure to the euro area is considerable. Fortunately, the euro area economy is stronger than a few years ago. Fiscal deficits have been reduced and banking systems reinforced. Moreover, new institutions and policy tools have been developed to limit the potential for contagion. In recent days, euro area authorities have made it clear that they, and I quote, stand ready to do whatever is necessary to ensure financial stability of the euro area. The bank has worked closely with the Treasury, the FCA, and our European counterparts to put contingency plans in place. UK authorities will continue to monitor developments closely and will take any actions required to safeguard financial stability in the United Kingdom. Looking beyond Greece, some risks have receded in the past 6 months, especially those arising from the macroeconomic environment in advanced economies. Others have increased, particularly those around emerging economies. And while the resilience of the institutions at the core of the financial system has continued to strengthen, risks are shifting to the markets that connect them and the infrastructure that underpins them. Greece aside, risks stemming from the macroeconomic environment in advanced economies have diminished. Most notably, risks associated with low inflation and high indebtedness in the euro area have reduced. And the outlook for the U.S. growth remains firm, supported by robust growth in real incomes. In the United Kingdom, growth has been solid, and the burden of household debt has continued to fall modestly, and its distribution has improved. Despite this progress, UK debt-to-income ratios remain high by historical standards. And after having slowed last year, momentum in the housing market is showing signs of returning. The committee therefore judges that the policies it introduced a year ago, policies which ensured against a marked loosening in underwriting standards and a further significant rise in the number of highly indebted households, those policies still remain warranted. At around 6% of GDP, the UK's current account deficit is very large by historical and international standards. The risks associated with this deficit are mitigated by the currency composition and the long-term nature of the capital flows that are financing it, as well as by the fact that the deficit is not combined with a rapid growth of domestic credit. However, continued smooth financing of our current account deficit depends on the credibility of the UK's macroeconomic policy framework, including our openness to trade and investment. The bank's 2014 stress test assessed what could happen to this economy and financial system if, in an extreme scenario, these assumptions were called into question. As I said a moment ago, risks have increased in emerging markets. Over the past year, economic growth has slowed notably in a number of emerging market economies, including in China. Following a rapid buildup of indebtedness, Chinese policymakers now face a challenging balancing act between sustaining growth, managing financial stability, and increasing openness. More generally, vulnerabilities have increased in a number of emerging market economies following a long period of capital inflows and rising private indebtedness, much of which has been financed through the capital markets and in U.S. dollars. The combination of weaker domestic economies, the strengthening of the U.S. dollar, and an eventual rise in U.S. interest rates may threaten the ability of those businesses to meet their obligations. UK banks' direct exposures to emerging markets in China stand at around 3.5 times their core equity Tier 1 capital. The bank will assess the vulnerability of major UK banks to an emerging markets downturn as part of its 2015 stress test. The risks we've identified should be weighed against the increasing resilience of our banking system, where capital positions have continued to improve in the past 6 months. As it moves from design to implementation of the requirement for banks, the committee is pivoting to focus on the risks in and resilience of markets. The risks arising from Greece and the global economy will test market liquidity and could potentially trigger broader adjustments in financial markets. In many markets, average trade sizes and market depth have fallen, and prices have become more volatile, with episodes of particularly sharp intraday price changes. But greater volatility does not in and of itself threaten financial stability. Indeed, to the extent it reflects stronger prudential requirements, it's a product of a welcome increase in the resilience of the core of the financial system. Markets will adjust over time to this new reality. The risk that concerns the FPC is that an adjustment in risk appetite could lead to a persistent dislocation in financing markets, dislocations which could be a product of the interaction between regulation, changes to market structure, and the rapid growth of market participants who take continuous market liquidity for granted. And this is one reason why the FPC is interested in the activities of asset managers. The FPC has been working since March to deepen its understanding of the macro-prudential risks associated with market liquidity. It will consider a final report in September and any potential actions thereafter. The Bank of England is also working through the FSB to assess these risks globally, and it will convene an open forum of a broad range of stakeholders on November the 11th to discuss developments in market functioning and potential measures to improve market resilience. Now, financial risks are not the only considerations relevant to financial stability. Misconduct has undercut public trust in the financial system, exposing fault lines in markets' soft infrastructure and posing risk to systemic stability with direct economic consequences. Fines and redress costs paid by UK banks now total £30 billion, roughly equivalent to all the capital these banks have raised privately since 2009. The committee will review the adequacy of sector-wide projections of future misconduct costs in its 2015 stress test. Now, fines will not rebuild trust in markets. That will require a better balance between firm and individual accountability. And the Fair and Effective Markets Review shows the way forward with a series of concrete initiatives at domestic and global levels. The FPC is also alert to operational risks or operational threats to hard infrastructure of the financial system. Across all sectors, for example, 90% of large businesses have experienced breaches of IT security over the course of this past year, with financial firms amongst the most targeted. As a consequence, the financial sector should continue to build its resilience to cyber risks and its capability to recover quickly. The adaptive nature of the threat means that the ways of managing the risk must continually evolve. And this requires strong governance at the most senior levels of banks. With this in mind, the committee is recommending that the resilience of firms and the infrastructure at the core of the system to cyber attacks is regularly assessed. So to conclude, financial reform has bolstered the resilience of the core of the UK financial system, and it's made it better able to withstand the inevitable shocks which will occur. Given this progress, the FPC is pivoting from the design to the implementation of banking reforms, and if necessary, we will make prudent adjustments to measures to address unintended consequences or inefficiencies. We're pivoting from banks to markets. Although the core of the financial system is stronger, market dynamics are changing in ways that are still not well understood. And the FPC will examine all avenues to promote the resilience and effectiveness of markets. And finally, we're pivoting from financial risks to operational and conduct risks. Balance sheets have strengthened since the crisis. The infrastructure that underpins the financial system, both the hard and soft infrastructure, needs now to follow suit. By building resilience across the system and remaining vigilant as the threats to that system evolve, the FPC will continue to fulfill its mandate to promote financial stability for the good of the people of the United Kingdom.